Okay, I need to tell you about the best day of my life, and then about how that day cost me $47,000. Same day, both things. The year was 2000. I was 25. I had just gotten a decent paycheck for the first time in my adult life, and I did what any responsible young man would do with his first real money. I walked into a dealership. Now, I want you to picture this moment: the showroom lights, the smell of new car, which is genuinely one of the best smells ever invented by humanity, and I will die on that hill. The way the salesman looked at me like I was a person who mattered. I was wearing my red jacket. I felt incredible. There was a car, silver, slightly sporty, more car than I needed, exactly the car I wanted. I didn't have enough money to buy it outright. I had enough for a down payment, and the monthly payments seemed totally fine, very manageable. The salesman used the word manageable 11 times. I counted later. I signed the papers. I drove home in my new car. I felt like a different person, a richer person, a person who had arrived. I was none of those things, but I didn't find that out until later. Here's what I actually bought that day. I'll use round numbers because the real numbers are embarrassing, and also I've partially repressed them. Car price, $28,000. Down payment, $4,000. Amount financed, $24,000. Interest rate, 7.5%. Loan term, 60 months, 5 years. Monthly payment, $481. For 5 years, $481 left my account every single month. Before I had coffee, before I had breakfast, before I had done anything at all, $481 gone. Total paid over 5 years, $28,860. So I paid $28,860 for a car I bought for $28,000 and put $4,000 down on. Add the down payment, I paid $32,860 total for a $28,000 car. I paid $4,860 in interest. Not for anything, not for a thing I can show you. For the privilege of using money that wasn't mine yet. That's just the money part. We haven't even gotten to the car part. Here's the car part. The day I drove off the lot, my $28,000 car was worth $25,000, not a metaphor, literally. The second you drive a new car off a dealership lot, it loses somewhere between 9 and 11% of its value. In the time it took me to sign the paperwork, shake the salesman's hand, and drive 3 blocks, I lost $3,000. I lost $3,000 in about 40 minutes. That's $75 a minute. I have never earned $75 a minute in my life. I was losing it with no effort at all. By the end of year 1, my $28,000 car was worth approximately $21,500. It had lost $6,500 in 12 months. I was paying $481 a month to borrow money to pay for an asset that was losing $541 a month in value. Every single month I owned that car, I was going backwards in 2 directions simultaneously. In the year 3000, we call this a double drain. You're paying to hold something that's actively shrinking. It's the financial equivalent of paying rent on a sandcastle. The tide is always coming. You're always losing. The question is only how fast. But wait, I haven't told you the really fun part. Insurance. When you finance a car, the bank technically owns it until you've paid it off. And because the bank owns it, the bank requires you to carry full coverage insurance. Not basic, full, comprehensive, collision, the works. On a new car, that's real money. In my case, roughly $1,800 a year, $150 a month. So my actual monthly cost of that car wasn't $481. It was $481 plus $150 insurance, $631 a month. Every month for 5 years, plus gas. My slightly sporty car got about 22 miles per gallon. Not bad, not great. Not the thing I thought about when I was standing in the showroom smelling the new car smell. But real, plus maintenance, oil changes, tires, the brakes that needed replacing at year 3 because apparently I drive with enthusiasm. Another $800 that year. Total real cost of owning that car for 5 years, rough estimate. Loan payments, $28,860. Down payment, $4,000. Insurance, $9,000. Gas above what a cheaper car would cost, roughly $2,000. Maintenance above baseline, roughly $1,500. Total, approximately $45,360. For a car I sold 5 years later for $11,000. I spent $45,360 to end up with $11,000. Net cost of that car, $34,360. For reference, $34,360 invested at 10% annual return over 20 years is $231,000. I drove a $231,000 decision off a car lot because the monthly payment seemed manageable. The salesman used the word manageable 11 times. I understand now why he did that. Now I want to be fair. I'm not saying never own a car. I'm from the year 3000 and even we have cars. We have flying cars. We still finance them badly and pay too much for them. Some lessons travel through centuries untouched. I'm saying the decision is much more expensive than it looks, and it looks expensive already. Here's how most people actually think about buying a car. Can I afford the monthly payment? That's it. That's the whole analysis. $481 a month. I make enough. I can afford that. Car acquired. Here's how the decision actually works. You're not buying a car. You're buying a monthly obligation plus interest, plus insurance, plus depreciation, plus maintenance, plus the opportunity cost of the money you could have invested instead. When you frame it that way, the math changes completely. Let me show you two people. Person A, that's me, buys a $28,000 car on finance at 25, pays it off over 5 years, sells it for $11,000, repeats this cycle roughly every 5 to 7 years for the rest of their working life. Always has a nice car, always has a payment. Person B buys a $8,000 used car with cash. No payment, no interest, lower insurance because no bank requiring full coverage. Takes the $481 a month they would have spent on car payments and invests it in an index fund at 10% annual return over 30 years. Person A's lifetime car costs in the range of $150,000 to $200,000, including all the interest, insurance differentials, and depreciation they absorbed. Person B's investment account from redirected car payments, over $1 million. Same income, same 30 years. One decision about how to get from place to place. I'm not saying the $8,000 used car is glamorous. I'm saying it might be worth $1 million. You decide how glamorous that is. But Fray, I hear you saying, used cars break down, used cars are unreliable, used cars are a headache. I hear you. I said the exact same thing. Standing in that showroom in 2000, I genuinely believed that a used car was a trap, and a new car was a responsible adult decision. The salesman nodded when I said this. Of course he did. Let's actually look at the numbers, though. A used car at $8,000 might need $2,000 in repairs over 5 years. Real repairs. Things actually breaking. So now you've spent $10,000 total. Compare that to the new car at $45,360 total cost. Even with repairs, even if the used car is genuinely annoying sometimes, you're ahead by $35,000. $35,000 is a lot of annoying. And in the year 3000, we have 1,000 years of automotive data. Cars built in the last 2 decades of your century are, on average, engineered to last past 200,000 miles with basic maintenance, oil changes, tires, not neglecting things that make noise. That's it. The idea that used means unreliable, is not based on reality. It's based on a story that was carefully developed and repeated by an industry that profits when you buy new. I'm not saying used cars never break. I'm saying a $35,000 gap covers a lot of repairs, and the car that broke down on me most memorably was, in fact, brand new. The dealership called it a known issue. I called it $800 I didn't plan on spending. We saw it differently. I'm not saying never buy new. I'm saying look at the full number, not just the monthly payment, and make the decision with real math. There's another version of this that's even worse, and I need to mention it because I've done this too. Leasing. A lease is when you pay monthly for the privilege of using a car you will never own. Returning it when the lease ends with nothing to show for it. And then immediately starting payments on the next car because you've become psychologically dependent on always having something new. With a loan, at least at the end, you own a depreciating asset. With a lease, at the end, you own nothing. You've rented a car for 3 years and built zero equity. The math on leasing is genuinely hard to look at directly, like the sun, or my old bank statements from the year 2000. The car dealership loves leasing. You know why? Because the customer always comes back. They have to. They need a car. They have no asset. The lease ends, and they sign again, forever. In the year 3000, there's a creature we have in the history books. It's called a lease customer. Historians describe them with a mix of pity and confusion, always paying, never owning, returning the car every 3 years like clockwork, having spent real money for nothing, getting a new one, starting again. The cycle is unbroken. The wealth never accumulates. The dealership's quarterly numbers are excellent. Don't be a lease customer. Okay, so what do you actually do? Option 1, buy used with cash if you can. 3 to 5 year old car, one previous owner if possible. Get it inspected by an independent mechanic before buying. Costs about $100 to $150, worth every cent. I know this feels like extra effort. It is extra effort. It is also the difference between buying someone's well-maintained car and buying someone's well-disguised problem. Pay the $150, talk to the mechanic. Listen to them. They are on your side. The salesman is not on your side. Buy the car. Own the car. Pay nothing monthly. Take what you would have paid monthly and invest it. This is the boring version. This is the version that works. Option 2. If you need to finance as little as possible for as short a time as possible. Biggest down payment you can manage. Shortest loan term you can afford. And here's the thing nobody tells you. Never extend the loan term just to make the monthly payment smaller. I know it feels like a solution. It isn't. It's how you end up paying for 3 cars when you bought one. The salesman will offer this to you with a smile. The smile is because this is good for him, not for you. Buy less car than you can afford, not the car at the ceiling of your budget, a level below. The difference between what you can afford and what you actually bought, that gap is your investment contribution. Put it there every month. Option 3. If you absolutely need a new car, specific safety features, specific job requirements, you genuinely have a reason. Buy it as a tool, not as an identity. The car does not say anything about you. I know it feels like it does. I know it felt that way when I stood in that showroom in 2000, smelling the new car smell, feeling like a person who had arrived. I had not arrived. I had signed a document agreeing to send $481 a month to a bank for 5 years in exchange for a metal object that started losing value before I reached the highway. I want to tell you one more number because I think it's the one that actually lands. If on that day in 2000 I had bought a $9,000 used car with cash, which I could have done, I had savings, and invested the $481 monthly payment I would have otherwise made into an index fund. Over 25 years at 10% annual return, that $481 a month becomes $640,000. $640,000. That's what the new car smell cost me. $640,000. And I've been thinking about this ever since I woke up in the year 3000 with no money, no car, and a strong understanding of compound interest that arrived approximately 30 years too late. Here's the summary because I know your brain is full. A car is not an investment. It loses value from the second you own it. A car loan is interest on top of depreciation. You're paying extra to hold something that's shrinking. The monthly payment is not the cost. The total cost, loan plus interest plus insurance plus depreciation plus maintenance plus opportunity cost, is the cost. Leasing is renting. You build nothing. Used cash, invested difference. That's the path that doesn't cost you $1 million in future wealth. The car gets you from place to place. That's it. That's the job. Don't pay $1 million for something whose job is to get you to work. I paid $34,360 net for a car I needed for 5 years. The same money invested would have been $231,000. I chose the new car smell for $231,000. Was it worth it? I mean, it smelled incredible. But no, it was not worth it. Subscribe, like, hit the bell. Bender just bought a new hover car on a 96-month loan at 12% interest. He says the monthly payment is very manageable. He has used the word manageable 11 times. I've heard this before. It doesn't end well. Don't be Bender. And please, for the love of everything, do not go to a dealership on a day when you're feeling good about yourself. That's exactly when they get you.